Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
Plug Power reported second quarter 2023 results last week, and as expected, the company is losing a ton of money. Continues to talk about being cash flow positive eventually. I think it's worth digging into exactly what the numbers look like and what the trends are for the company that we know about, because promises are not going to make the stock recover. The company has to actually improve operations. So that's what I want to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I want to go right to the release. This is the income statement for Plug Power, and I just want to highlight the numbers here and just how bad they are from an operations perspective. There are a few line items under revenue. Sale of equipment. You can see that the company is making a little bit of margin there, about $30 million of margin on the sale of equipment that it's making. Services, however, are losing money, about $15 million in losses on services, on fuel cell systems and related infrastructure. The other two big line items are power purchase agreements and fuel delivered to customers and related equipment. Those are both things that should make money from day one, but they're not, and not in a big way. $16.1 million in power purchase revenue. The cost to deliver that power, $54 million. Fuel delivered to customers, revenue of a little less than $18 million. The cost of that revenue was $64.5 million. As a result, the gross loss was $78 million on $260 million in revenue. So revenue was up sharply from a year ago, but gross loss more than doubled. That's just a terrible trend for Plug Power. If we move down here further, you can see that operating expenses are also going up $156 million compared to $114 million a yeyear ago. That means that the operating loss was now $204 million. Net loss ends up being $236.4 million, or 40 cents per share, just for a single quarter. What I'm most interested in with this company is the statement of cash flows, because at the end of the day, I question whether Plug Power is going to be able to survive, generate enough cash, because historically what the company has continued to do is just sell stock to raise money and just continue burning cash year after year after year. But the numbers are just getting astoundingly large. You can see that in the first 6 months of the year, Plug Power has burned $625 million in cash from operations. There's also been $320 million in property, plant, and equipment acquired, so about $1 billion in capital needed. And where does that money come from? Sale of available for sale securities. Now, it is worth noting that Plug Power does have a decent balance sheet, especially if it wasn't burning any cash. You can see $580 million in cash, another $173.4 million worth of restricted cash, and then available for sale securities, $438 million. But you can see that that is down from $1.33 billion at the end of 2022. So the cash burn is just increasing at an astounding rate. And at the current rate, the company has less than 1 year of runway left with this current cash balance. How is the market reacting to this? Well, not really very well. You can see that year to date, the stock is down 29%. If we go out 1 year, it's down 70%. So definitely not heading in the right direction. And I think Plug Power needs to turn these operations around sooner rather than later. The challenge for Plug Power, and what I have been talking about for years, is that management has been talking about getting to EBITDA break even or operating cash flow break even for years. I have been writing about this for almost a decade, and it has never happened. What ends up happening is that the ambitions of the company just get bigger, the losses get bigger, the stock sales get bigger, and it's just an endless loop of dilution for shareholders. Now, eventually that's going to end, but the only way for it to end is for the stock to continue declining. That's what I think is going to keep happening for Plug Power. Eventually, management is going to have to raise more money. Stock is the most likely way to do that. So I could see more dilutive share sales in the future, especially at this rate of cash burn. I know that there are operations that are getting up and running that should be running in 2024. Hopefully that will improve operating results. But we have heard this same story before, and I'm going to be skeptical until we see actual cash generated by operations. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.